Když jsem s vámi naposledy mluvil ohledně akademického debatování, tak jsem vám říkal, že jsem vyhrál tuhle trofej akademické mistrovství Česka a Slovenska v debatování. Tentokrát jsme se spolu s mým partnerem pokusili o další soutěž. Jeli jsme na mezinárodní mistrovství v debatování, které se uskutečnilo v Praze a skončili jsme v semifinále. Bohužel se nám to nepodařilo vyhrát. I tak v rámci toho turnaje tak jsem byl 10. nejlepší řečník, což znamená, že jsem byl nejlepší řečník Česka a Slovenska, který se zúčastnili toho turnaje, ale bohužel to nestačilo na lepší debatéry z Německa, případně dalších zemí. Ono totiž kompetitivní debatování je poměrně rozšířené v jiných částech světa, především v oblastech, které nebyly tolik zasáhnuty komunismem, takže v Americe, v Británii se to během po druhé světové válce debatování dost rozvíjelo, soutěžilo se na školách, univerzitách a bohužel naši republiku to úplně nezasáhlo. Takže snažíme se dát Českou republiku na mezinárodní mapu. Přišlo za námi docela mnoho lidí se slovy wow, vy jste byli fakt dobří, i přestože nejste rodilí mluvčí, tak bychom vás nechali jako postoupit do finále. Mimochodem, jeden český tým se dokonce do finále dostal. A v rámci tohoto videa, který dneska uvidíte, tak se jedná o semifinálovou debatu, ve které jsme debatovali my s Petrem na druhé opozici, což je jeden z týmů v debatě. A ostatní týmy byly, pokud se nepletu, z Německa, jeden byl z Balkánu, pokud se nepletu, ze Srbska a potom jeden tým, který nás porazil, tak byl z České republiky. Téma je, tato vláda by zakázala high frequency trading, to znamená algoritmy a mechanismy, které jsou schopny v rámci milisekund udělat transakci na burze. Takže si představte něco jako biznis Karla Janečka, prezidentského kandidáta. A tohle je přesně to, o čem jsme debatovali. Pokud by vás zajímalo, jak tahle akademická debata funguje na mezinárodní sféře, kde v semifinálové debatě jsou jedny z těch nejlepších týmů světa, tak se určitě podívejte na tohle video, dávejte like a odběr a pokud si myslíte, že tenhle debatní přístup je dobrý pro Českou republiku a že je dobrý nápad učit lidi debatovat, tak za prvé dejte mi like a odběr, já budu za to velmi rád, ale za druhé můžete nám dát donate, protože já spolu s dalšími mými kamarády vedeme jeden z největších evropských debatních klubů. Debatní klub debatní spolek Debatního deníku se to oficiálně jmenuje a scházíme se každé pondělí od 18:30 na Smíchovské střední průmyslové škole. Pokud byste chtěli přijít, máte link v popisku a přes tenhle QR kód byste nás mohli finančně podpořit, za což vám budeme strašně rádi. Snažíme se rozšířit se po celé republice, snažíme se vzdělávat lidi v akademické debatě a učit kritické myšlení. Takže pokud chcete, aby vaše peníze přispěly na takový charitativní neziskový projekt, jako je naše organizace, jako náš spolek, tak budeme nesmírně rádi. Užívejte si tohle video a mějte se krásně. Jo a málem jsem zapomněl. Další videa z celého turnaje, protože my jsme natáčeli i další debaty, můžete najít na našem druhém kanálu, našem spolkovém kanálu, který se jmenuje Debatní spolek Debatního deníku, kde najdete videa z finálové debaty, najdete videa z předcházejících kol, takže určitě se připojte a podívejte se na to, jak vypadá taková akademická debata.
I mean, this wouldn't be a proper semi-final without an econ motion with people who know jack shit about econ. So, with that being said, I want to talk about two things in my speech. Firstly, on financial risk, and secondly, about ability to participate in the markets. Let's talk about financial risk then. Firstly, why do we think that overall, on side of opposition, there will be more incentive to take on more risks with these high-frequency stuffs? Three reasons for that. Firstly, it has always been about speed. If they think, or if the main metric becomes in their world that speed gets you results, it has also reflected that throughout every point in financial history where it's about picking up your phone the fastest or being able to set up some sort of programs to do that the fastest. Second of all, taking out the human component simply makes it actually about speed more. First of all, because success comes with being fast. If some do it at the start, it's going to progressively influence others because those who do it the fastest have an advantage, thus creating an incentive for others to also start using it. And also, at this point, we say that that basically creates an environment of competing over speed with these algorithms. It's not about, if it's not fast, you're not making money anymore. Thirdly, after this point, how is that speed actually gotten? And this is the core mechanism of our case here. Two reasons. Firstly, Processing takes time. Analyzing the actual risks that come along with like financial decisions takes fucking time, right? You have to give up some sort of processing power, some sort of like ability to look forward in time to make these things faster, right? Or cut corners in terms of, I don't know, making these algorithms more risky, to actually make them faster, to have the advantage over others, to earn more money. Risk arises on every single level. Before I say why it's likely to backfire, shoot.
I understand that you don't understand economics, but like you're confusing causality with correlation. The reason why they are so speedy is because they have so much information that they can process. That's why they're so good.
Okay, it is also about the access to that information, right? You have to not only have a large, kind of diverse pool of data that you can analyze, but like diversing through that and actually making the best decision, and also analyzing outcomes and probabilities takes still time and doesn't rely on the initial data, right? These things still mean that there is more risk. Why is it likely to backfire? Firstly, markets are just volatile. They're volatile already. If we take more like computing out of it, we think that overall they become more volatile. And secondly, we have an incentive to continue this climb in volatility because it's simply just the best firms make more money with it, so it's the same competition risk. The impacts of this is simply, why is that risk bad? Two levels on this. Firstly, it's already fucking very risky, you're just making it more risky. Three outcomes that this is going to have. Firstly, best cases. Most firms are just going to have more losses. Secondly, like the middle impact here is that you're going to lose actual large assets, like, I don't know, a substantial part of a pension fund or something like that. And the worst outcome of this, given also these mechanisms coming from a second argument, is an actual financial crisis, given that there is going to be more monopolization, which I'm going to explain later. The second impact stemming from this is about employment. We're not actually just like throwing around assets for nilly-willy, right? We're playing with actual money that actual people own, that they have handed to these firms to, I don't know, get their pension back or something like that. We said that overall this is going to create two things with employment. Firstly, automation just means that less people have less physical jobs, which you can lay off people, hardworking people who need that fucking money. But second of all, re-employment, meaning that a lot of these jobs are going to become much more tech-focused, needing more education, more time, and also relearning the skills that you actually already have acquired that are useful right now, but now you have to retrain these people, taking time, money, and actually making those people's lives worse. Why do humans overall have less risk on our side of the house? Three reasons. One, humans are slower. Two, people are just more risk aware in comparison to machines, right? I actually cannot be in a situation where I don't realize the risk, especially if I know financial instruments very well. And thirdly, because you just feel the backlash more. Firstly, because of the shame and guilt that might come along with it. But even if that doesn't exist, on their side of the house, it is easier to talk yourself out of trouble if you end up in trouble with that machine. It is a reason why during the 2009 economic crisis, a lot of financial people who caused that situation said that, hey, just everybody's doing this and going along with the trend. That's why we're in a bad situation. It's not on me, it's on everybody, right? You're going to diverse that risk, and the backlash that you're actually going to get, that is going to happen on their side of the house, is going to be divested to programmers and people like that who actually run those algorithms, right? With that being said, second argument about the ability to participate. And this is a really interesting case, I feel like. 2 points of why, what even these technologies existing are going to, what are the ramifications of those. Firstly, distance is a thing. Secondly, physics is a thing. Lastly, electronics are a thing, meaning that if I live farther away from an economic center where a lot of those servers and stuff exist, the signal is just going to take longer to get from point A to point B. What are the ramifications of that? It is that if I'm not close to, for example, London or New York, where you have a financial center, and I make an investment, that speed doesn't even matter that much anymore, because the signal just takes longer to travel. This is just going to be going to consolidate these financial markets into already existing very large stock exchanges, just making that kind of inside group works. And secondly, just patents and stuff like that for these algorithms. It is still developed tech, not run by humans. You can't patent human thinking. You can't patent algorithms. I think these things mean two things in terms of under the large umbrella of monopolization. Firstly, more power to these very small groups of institutions. That means that overall they're going to have more power. But that power in and of itself we feel like is bad, but also it creates dependency on very risky institutions. And if they fuck up, now there are fewer of them, everybody fucks up. Again, 2009. The second thing it creates is just control of the market. Three things stemming from that. Firstly, people who rely on those firms to actually accept their risk now have lesser alternatives to compared to these large firms. But second of all, they can raise interest rates and stuff like that for customers simply to make more profits. And lastly, and most importantly, you make more surplus profits coming from the people who have no alternatives, making the lives of people more shit. Proposed.
Large investment firms will make decisions that can wildly damage the economy into any foreseeable future that we can possibly debate here. So we are unsure why opening government is pretending that it will never or has never existed under human-controlled and emotion, whatever they want to argue is the mechanism for that here, mechanisms there. What three things are we going to prove to you in this debate? First of all, why investors are now able to be more accurate with any calls that they make and any risk assessments that they make. Second of all, why we can somewhat close the gap between large investment firms and retail investors, increasing participation in the market via accessibility. And lastly, why we can guarantee big social funds such as pension funds can actually be paid out into the future despite the current modern risk that we see today. Before that, going on to responses for OG, I find it kind of laughable how they mentioned 2008 when that very much did happen without high-frequency trading links. This happened because individuals were not able to foresee that their small part in simply trading something or selling on a service or package like housing mortgages was able to lead to such a big crash in the first place. They are one individual participating in one course of action. They do not see how this multiplies over the entire global scale or over the entire market and economy to be able to cause that much risk or to be able to cause that big crash in the first place. Comparatively, you have a computer that can almost instantaneously process that data, or if not instantaneously, simulate enough situations where you can navigate that risk to be able to perhaps even make a positive financial outcome, or to be able to stop before you actually get to a market crash. Here's the thing, panel. Investment firms don't actually want market crashes to happen. When market crashes happen, you oftentimes cannot convince your customers or your consumer base to invest into things that would otherwise get you money because they don't have the confidence that the market is strong enough yet. It sets you back in any kind of financial firm goals you have. It's oftentimes that your investment bank or investment firm will have to close down because you are unable to make a significant profit for about 2 years, and because everything moves very, very hard and fast in your firm, so that you are unable, rather it is unfavorable for you to take so much time without actually having or being able to generate a profit. I also don't understand why they assume that there's a human, or rather that there's a human component within investments, because this would have to be, perhaps would be the case if there was one individual executing a trade where that one individual's hesitation would likely lead a firm to not become insolvent or to not actually disband itself because of their stock price. The thing is though, you have multiple investment firms constantly competing with each other and constantly having to predict whether these things will go right, meaning that any kind of emotional human risk assessment of, oh, maybe we don't want to make all these people unemployed, just literally never happens on these sides. First of all, because they're fucking investment bankers, they literally don't give a shit about people. They give a shit about their job security. They give a shit about however much prestige they can make from their position, and how much they can network, and how much they can do for their company and the firm, because their company and firm gives them a lot of security into their future that they can then pass on to their children, parents, etc., etc. All of these good things that we know and love. And second of all, it is very far removed from them. They will never see the drastic effects of them dissolving a firm or causing a firm to dissolve because of the fact that they have made an investment decision, they have clicked a trade option, they have shorted them, etc., etc. I do not understand why this will ever come into play. When we bring in, however, high-frequency trading platforms, this oftentimes can mitigate that risk to a larger degree. It oftentimes means that you actually look as to whether a firm is failing, whether you can get or squeeze a tiny bit of profit out of it. It means that firms are more likely to not be closed down because an individual has assessed that its valuation is lower than what it should be and simply decided on whatever human metric or whatever experience that they have that this is going to be the case. When you have a high-frequency trading mechanism, you oftentimes can run simulations as to where you can get the maximum profitability out of a company. And at the point that you do want that maximum profitability and you do want that to go well, it is oftentimes that you are going to make the exact correct decision, leaving the company alive for as long as it can feasibly be. Also note that this company, if it simply does not produce, like, irrelevant of its investment level, if it cannot produce profits or it cannot be sustainable to the future, will die anyway. So oftentimes this the high frequency trading mechanism will leave it alive up until that point, because it literally does not make sense for it to go any further, but it does make sense to invest in it because this aggregates into a stronger economy as a whole. Second of all, we can close the gap between large investment firms and retail investors at the point where we believe every kind of algorithm and every kind of mechanism have somewhat now been packaged and sold off to consumers in some form. We believe that these companies, in order to generate extra profit for themselves and in order to be able to have better control of the market, will likely sell off packages to individuals saying, hey, if you invest this much and you trust us with our money and you pay maybe like a 0.05% fee on all trades, etc., we will be able to get you more money. And it benefits them to do so. If you are able to have individuals bump up a stock price because you want to, or you believe that this can be beneficial for you, or you believe that this has a lot of future in terms, this in turn makes the value of that stock higher, meaning that you have gained more money. And I don't want to hear any arguments like, okay, maybe they get a worse price. Even if they get a worse price comparatively to the company itself, it is still a better price than they would get if they did not have this opportunity to invest without having to necessarily have deep amounts of free time, financial literacy, etc., but simply wanting to maybe invest their money so that they can provide, I don't know, leave something for their grandkids, leave something for their pension, etc., Go ahead, closing.
In 2008, there were people and investors who betted against the financial market and went shit ton of money.
This will literally happen on both sides of the house constantly. People love betting against the market. They did it now. It didn't work out for them. They just got lucky. There will always be immoral people betting against the financial success. But most of the time, most individuals would like to have a market that is stable, because this oftentimes means that they can benefit from it too, because they can go out and buy like the services that they need, because they can influence the amount of money that they have to a greater extent. Financial market crashes are not a reliable source of investment, as it is just about having a stable economy. Lastly, I think this guarantees big social payouts such as pension funds at the point where pension funds oftentimes are only invested into risk-averse investment, i.e. those that generate low income or low returns, but are generally very, very stable and unlikely to change over time. When you are able to make more accurate calls on what is traditionally seen as risky investments, you are able to get more of a revenue out of pension funds. What this means is that when you have an aging population, when you have population decline, so individuals from a domestic population cannot necessarily contribute enough tax to be able to pay for future pensions, you are able to guarantee a payout for pensions, and therefore more like social cohesion and stability within your nation itself, at the point that you are able to provide a service that would otherwise be very, very difficult to do at the end of people's lives. For all of these reasons, we are incredibly proud to oppose.
I'm going to say something shocking. I actually know this shit. So now onto the speech, because this is very important in opposition. What we are banning here is specifically the high-frequency trading tool. It is an automated tool that uses all of this data, that is making the decision about the trades, and that is doing the trades within milliseconds. We are not banning the use of algorithm, the use of data, the benefits of all of this information. If opposition wants to run this information, is super duper important. We can have those benefits as well, but we still have a human being involved in here. We still have less of the automation happening here. And that is the case that we are getting from Tommy, that specifically this automation where we are making it even more a game of seconds, where we are removing even more of the risk that this is creating, making it significantly harder. Because what is important, yes, maybe we make less money on our side of the house, but at least we are also losing less money at the point where we have the possibility of more control going to be happening. So we do get all of the benefits of this just with less risk. Why is this risk so incredibly dangerous? Alex comes very flippantly up there, like, ooh, the financial crisis of 2007 was because of people. Yes, It would be worse if it was because of automation. Like, this is the point that we believe that humans are safeguarding factors that can make things become less bad because of the reasons that Tommy has given you. It is as simple as the fact that you have more of the possibility to stop something at the point that there is a factor that makes it slower in the first place, which is the human factor that we are having here. But then there's even more reasons as to why humans involved in this is incredibly important. Because we get this pushback from Alex that's like, ooh, financial traders do not care about people. Number one, the people programming the algorithm under their analysis probably also don't. So I'm unsure about like why they have more care about people on their side of the house. But it was very important to note, this is just false. The people who work in finance also have family members. They also might come from a poorer background. They also know that what it is to be a student or something like this. I think it is unfair to say that all financial analysts are just fucking idiots. But what is or fucking psychopaths? But what is also important that there's a magnitude of other people involved in the financial markets. Even if they are all of them are psychopaths, they still have people who they are involved with, and this is incredibly important. A psychopath's mind can be changed. What cannot be changed is at the point where you have this machine into them, because this is already incredibly important, and this is literally every single stupid analysis about losing control over AI, which is here as well. In order to be creating the amount of information processing and speed that they have to be doing, you have to automate it to the degree that you are unlikely to actually know what the fuck is going on in very different positions. When you have one human being failing, it is significantly easier to pinpoint which exact problem created the issues that have been happening here. So if we have a failure to a degree, you can figure out the person who has made this decision wrongly. It is probably easier to ask that than to figure out at which step of this machine this is going to be happening. But what is incredibly important also, it is easier for a company to throw one individual under the bus that they made this mistake than to throw your entire company under the bus. Because this is important. These companies make their money by the unique benefit of algorithm and tool that they are having. You are not going to say that this was the flaw of my algorithm at the point where something goes wrong. You're significantly more likely to be calling out people. But more reasons as to why people are more risk adverse. And Tommy already talked a lot about this. But number one, there's a lot of shame and guilt associated with this. Even if you're a psychopath that only care about the standing that you are having, you want to keep your standing. You're more likely to not do the risks that are so insanely high on comparison because you do not want to be the person who caused the failure and then probably lose your job. But then second of all, also it is easier to talk yourself out of trouble at the point where it was the machine that did the mistake and not you as an individual. You could just consistently blame it, and this was the problem in 2008 when nobody wanted to be responsible. No, this was just the market who decided to be doing this. This is going to be significantly worse at the point where you can just say, oh no, this is just the machine that has been doing this. But what is also incredibly, what is also important here about this is just we think that risk is the biggest problem because of all of the harms that one failure to one degree can happen. Lowest level is somebody does a bad trade, lose money. Middle level is pension fund get lost. But the biggest level that this is happening, this is specifically on the monopolization part that Tommy also ran to you, at the point where we make everything even more dependent on these few companies that are doing this. Why do we have so much more monopolization on our side of the house? Because number one, it is already really fucking bad in the monopolization of the financial markets, just saying. But it is going to be worse at the point where you can just more easily patent all of the things that make you so unique. But this is a location factor. They cringed at this. This is suddenly spec I have on finance. But this is actually important. At the point where we are talking about milliseconds deciding this, it also depends on where you are. So all of like these fancy retail trading data, they're just not close enough to actually have the benefits of making all of this, these decisions and all of these tools. Closing.
Yeah. I know debating world is more left-leaning, but you still haven't proved why more monopolies on this field is bad inherently. You have to have some kind of economic analysis.
I literally just said it. Having less companies, having less of them, one of them fails, you only have 2 left. If you have 8 companies, one of them fails, you have 7 left that can still save your pension funds. It is pretty easy. But also, listen to Tommy, because he's always been saying this. At the point where you have multiple of them competing, you first of all have competition and the degree of safeguarding on this level that we are talking about here. But also you have less influence on other countries at the point not 3, you have less power overall because they are less dependent on you, because they could go to somebody else. Cool. Why is this retail argument stupid? First of all, we get no analysis why retail trading is good. We actually see that people are losing a significant amount of money. We have been seeing that scamming in terms of like retail trading has gone significantly up. We think that it is probably better that this is being done by the people who are educated in this, who have an idea about what is happening, than the average Joe who thinks that they can actually do this trading well. But we also see a significant rise within addiction. But what is significantly more important, like those apps also exist on our side of the house. You do not need high frequency trading in order to have like apps where individual people can make good investments into this, because the individual does not actually have the resources and the power tools that are behind this, because this is not about just about having the algorithm and the app, it is also about having the processing power that gives you this speed about those things. In order to be avoiding risk, in order to save people's life by not fucking them over and avoiding monopolies, I beg you to propose.
OG's entire case is on risk, and our entire case is also on risk. It's great. The problem that I think OG misunderstood is that it's not that everybody is forced to use high-frequency trading and choose a very risky product. The way that it works is that on both sides of the house, these financial firms offer you a wide palette of different products you can buy. Market-specific, do I want to invest in green things? Do I want to invest in the tech market? But also, they give you options on, do I want to invest in risky assets or low-risk assets? And the delta is then on the capacity for these firms to follow through on the product's promise, i.e. whether their assessment of low-risk investment is correct or not, and whether their risk assessment of high-risk assessment is not, and that is then their comparative. What we tell you is that their capacity, thanks to high-frequency algorithmatized process, is then significantly higher. Opening government in DPM pushes back on, no, we're not banning algorithms, everything can still do algorithm. I would argue that the motion does tell us that this is then used to process vast quantities of information and conduct trades. I think this is conjunct. That means I do think that there is a delta on how much information this algorithm and this high-frequency trading is then able to process and then act on. But I think we can win on both of them, if it's with information or without information. Because first, like, why is their capacity higher? Because the amount of information that they're able to process is so significantly higher. Prime Minister tells us that humans are better because they're slower. That doesn't work if everybody still uses, like, slower to process information. Doesn't work if everybody still uses algorithms, as then DPM tries to tell us. But the amount of information that exists out there is likely going to be similar. But the capacity for an algorithm to sort through this is significantly higher, because my one human brain cannot process the financial information coming out of a single day of the world. I would argue that an algorithm can. Secondly, and this is where the speed of the trading also comes in, they can act on this information more quickly. Yes, humans are slow. If they calculate everything by hand, probably not comparative, but probably that takes time. If they still have like some information, it's still, you have to drive into the office. I mean, imagine telling a pension fund, sorry, Sarah wasn't in by 9, so you lost $9 million, like, I don't know, dollars or something. Like, this is not like what I'm actually telling is going to happen. I'm saying this is exemplary of what it means to, if this isn't an optimized process that can immediately and quickly react to new information coming in there, then your assessment of low or high risk, which has changed in this second, has changed in this hour, then your capacity to act on it is significantly limited if you have to wait on a human to push the button. Right? Thirdly, and I think that this then clashes with what comes out of DPM on when is it easier to course correct, who learns better, when can you eliminate mistakes. I would argue that with high frequency trading, when this is algorithmatized and optimized, you have compounding learning on your traits. I.e. when people, I don't know, start as a trader, they don't do this for 150 years, right? There are people, sometimes they die, sometimes they burn out, sometimes they just want to stop working or switch fields, right? But everybody starts at some point. Everybody makes mistakes at the start. Everybody even sometimes makes mistakes at the end of their career. The nice thing about having this be an optimized process and the algorithm learning from its own mistakes and never ever, like not every 5 years being in a new beginner phase, as a human trader would, means that you have compounding learning, compounding amelioration of your capacity to correctly assess whether a trading is investment like low risk or not. Fourthly, I do think it is a benefit to take the human factor out of it, i.e. do I want to have social prestige or not social prestige. Opening government pushes that people are very risk averse and don't want to feel shame and lose standing. I think by and large, most people are risk averse. I would argue, however, that people who are traders on the trading floor are specifically selected for their capacity to want to engage in risk, and specifically selected and trained to try and want and seek that high. I would also argue that there's a social dynamic in there that leads you to no longer be risk averse, even though maybe when you came in you were, right? Because the dynamic is, I don't know, you see on the board who has the highest returns on their investments. That means even if you're in charge of, I don't know, handling a low risk product, you might be more inclined to push a button that isn't necessarily in the interest of the product that you're supposed to be administering here, right? That means I think the capacity or like the likelihood of human factor leading to risk aversion when it isn't wanted, or, and this is the flip side, if they tell us humans are always more risk averse, there are still people that want high risk products bought, and they want high risk people. If they all risk averse, then they won't do these high risk trades. On either side of the house, humans have lower capacity to follow through on the specific parameters that are set out in this product. I would argue an algorithm can and does. Then, secondly, who then benefits from this increased capacity? And those are two stakeholders. One, risk-averse funds with large financial stakes, or risk-seeking funds with large financial stakes. Why? Because they both end up reaching what they want better on our side of the house. Why? Because if you're a pension fund, you seek stability. What your point is to provide for people for a long term in the future. Even if you have the best trader for the first 10 years, probably you plan your pensions for more than that. The algorithm is the same. Algorithm compoundly improves and is able to deliver on the stability you seek. Secondly, if you want high risk returns, where you're willing to gamble some money as with large financial stakes, there as well, the algorithm will not magically change character. It does not have a traumatic conversation with their father and suddenly decides I'm actually a moral person instead and no longer do immoral trades. These are all things, mood, ideology, I don't know, a spiritual moment and awakening that you have with human and that you don't with algorithms. CG. Yes, sir?
Do you know that you can still use algorithms and automatization, just not use them in high frequency?
The point is that it's specifically the trading that leads you to access the benefit, right? If it happens at the fast time. You can learn quickly when it makes sense to do this immediately and now as an algorithm. You know you can act on new information incredibly quickly. This is where you provide the benefit in the correct risk assessment. But secondly, are the small people and retail investors, right? They too sometimes put amounts in the stock market or buy financial portfolios or financial products with what for them is also a lot of money. Some are willing and want their preference to be fulfilled to have high risk gambling and maybe, I don't know, for my 1,000 I make 10,000. But some are like, hey, this is, I don't know, my savings. I want continuous low returns that are above inflation. They too profit from these products having higher capacity to correctly risk assess or not risk assess because it allows them to access preference to have financial planning for the future, for their retirement, for their children. I think we unlock benefits for large financial products and then trickling down to the economy and the consumer and the individual as a whole, that they have better capacity to have and access financial means in a long and planned future and be able to look forward and plan their life around it. For all these reasons, proud to oppose.
3, 2, 1, go. Panel, the motion isn't that the companies shouldn't use data to assess companies or to develop new products. The first table fundamentally misrepresents what high-frequency trading is, and I will be the first one to explain it. Thank God for my COVID obsession with finance, right? First of all, what does it actually mean? Yeah, it is. We agree with the characterization that the algorithms process infinity of information at a very large speed. But what kind of information is this? First table tells us this is the information about the company or about some products, about people behavior. This is just not the information they process, right? These are mathematical models, right, Tim, that process the patterns in how the market moves. That means, for example, if the market goes up but fails to break one price level 2 times, it is more likely that the market will go down. Therefore, it triggers an algorithms that automatically shorts this stock. No, thank you. And this is happening automatically, and this is happening very fastly. They are doing that on margins of dollars, on minuscule moves by the margin of dollar basically, but they are just very leveraged. That means that basically what you mean when you are on leverage is that if you gain like 1/10 of a dollar, they will make it 10 times as more because of mechanism. Why is that so? Even if they didn't believe that, it is true, but even if you didn't believe so, just this is more probable because if you were to assess like real life information, you would have to have like programs that scrape the web for news, and you would have to have like inside data of the companies and stuff like that. This is much more difficult and expensive to access than just the mathematical models that work on probabilistic levels. Now, what does it mean is that something, it might be a real-life event, but it must be also an arbitrary, like, clash of algorithms, triggers a move in the market, that triggers the bots to sell automatically or to buy automatically, that creates more actions because more bots react to this action of, like, the stock moving up or down. That creates more volatility in the market, and here we get to the impacts that they never explained, right? What does it mean if there is more volatility in the market? If, for example, like 60% of the bots think this move triggers the stock going down, they will all sell. The stock falls down. What does it mean? If it's an individual company whose stock's doing that, this company can be pretty much screwed because they now don't have the money. They might like go bankrupt. They might have to fire people working there. Hence the sad people, unemployed people, and stuff like that. Please note that this is much more risky for smaller companies where there is not that many like trades and transactions going on them because not that many people know them. So smaller companies are at higher risk of this because every like action can trigger this like spiral. But please note that this can happen even like on a worse scale, right? This didn't happen yet, but we believe that the chance that this is going to happen like increased largely. No. And that is that it could actually cause the market crash. Because if these algorithms took down a stock of a real important company, there might be panic at the market. People might pull out that money. That would cause more panic, spillover effect, blah, 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 blah. The financial crisis is happening, basically. Now, this might seem far-fetched, but note that the risk of these high-frequency trading algorithms are getting more and more prominent as we also put AI into account. And like it might be good for some of the companies to use like AI to develop the algorithm of their high-frequency trading bot, but then they don't have any input into what's going on because it works like a black box, right? With AI, you don't know how it got the results, so there is no safety and security mechanisms for those bots, and it could create the spillover effect even worse. Opening, sure.
If people's trades are still informed by the algorithm, won't the same algorithm that recommends the bots to sell everything also recommend the humans to sell everything? And why wouldn't they act on this information that the algorithm gives them?
Yeah, okay, I will explain why the humans won't engage with the market in my point of extension, and I will really get to that. But first, what is the general contrafactual, right? We believe that, yes, on our side of the house, there will be still risky trades, there will be day trading and stuff like that. There will still be people who would be analyzing the patterns, but we believe they would be doing it more slowly and based on actual information. Like majority of the investors would be actual people or companies who make it based on a press release about some data, like in this quarter, this company earned that much money, therefore I sell or buy, right? This is much more better because it actually, this is the market mechanism, this is the capitalism, right? You give the money to the companies that have a good product, therefore they can develop and they can make the world better. But secondly, it can also create like, you get, on our side of the house, it is more likely that people, that like, value investing based on your like alignment with, for example, environmental values are happening. Now to get to engage with the OG. Why this actually pushes like individual traders or investors out of the market? Because now the market is unpredictable. In the past, or if there was no high-frequency trading, you bought a stock because you thought this company has a good product, it will appreciate, it will go up, and I will earn money. Or I really believe in this. Now, whether the company goes up or down is based on like some very abstract and complex algorithms that you don't understand. Therefore, there is more risk for you to go to the market. Secondly, if you even go to the market, it is more likely that you lose because the algorithms are more like better in assessing whether the stock will go up or down. Therefore, they will outperform you and screw you on the trade, right? That eventually means that majority of human investors or companies that use humans to invest will lose money. Therefore, they are less likely to invest more. That means that they have less chances of like social mobility because they won't get the passive income from dividends. They won't get the appreciation of their stock. and stuff like that. Ultimately, that also leads to the other impact that the OG also mentioned but didn't prove, and that is like the concentration of wealth for those companies. Because if you push out like the normal investment companies and individual investors out of the market, and it's just like companies with really strong algorithms, then yeah, there is more chance of a monopoly or oligopoly of these companies, like basically being the only ones influencing the market. Wow, I have 20 seconds spare, but I said everything. Vote for us.
Thank you! Thank you for explaining how it works. Now, I think this debate will be won probably either by opposition sweep or closing table sweep, because we're the only ones explaining how it actually works. The biggest lie in the world that you understand financial markets has been disproven. Now, to actual speech. I'm going to bring you two main pieces of extension. I will explain how high-frequency trading changes the narrative of how people see stock markets and why it's super good for poor people who do not understand financial trading. And secondly, I will explain, and this will directly clash with the closing government, I will explain why there will be more stability on the markets, so exactly in contradiction with everything the closing government was saying. So, before that, I'm going to quickly address opening opposition. Notice that they did like two things that were itchy. Number one, you didn't really prove why we should ban something, you just proved why we shouldn't ban it, why it's really, really good. So, number one, this is going to be a big piece of my extension. And number two, I'm going to address and accept the fact what happened on opening government and saying that, yes, information is not enough. We need to act immediately on this information, so we're outframing the burden that they put on our table as well. So, first argument is about stability on the markets. Exactly what Anička said in her speech, these AI algorithms are using pattern recognition, so they're more likely to understand how these markets work. So if you see like a business cycle, they identify the points where to sell or buy. Why is it super good? Because what this actually proves, what they are trying to find is if the company is undervalued or overvalued. This is the only thing they're looking in this pattern recognition. Why is it so important and why it leads to more stability? Because companies that are overvalued on the market are more likely to fail in the long run if it's not identified by the market and people stop trusting them, right? So you are more likely, so if you sell it in the short term, yes, the company is not going to be that better off, but it means that the market is not going to crash so fatally. On the other hand, if the company is undervalued, for instance, by the way, black people companies, like if you have a small business run by a black person who opens a share or something, they're undervalued in the vast majority of instances. And fun fact, when we established high-frequency trading, guess where they started investing? So these are the ways how they under or overvalue these companies. Why is it so good and what is the impact of this argument? Number one, if you have overvalued companies, so market doesn't really understand how it's going to develop, you exactly get to 2008 crisis. Like the major reason was that if you watch the movie Big Short, like exactly the reason why they were able to identify the gap there was because they knew that the information of the market is limited. So we're getting more information, therefore more likely to predict something and less likely to have a catastrophic crash. Why is it good? Guess why? Because if a company fails, everyone fails. I'm going to quote second speaker for opening government when she said that, well, the companies are kicking one person on the ground and that's bad. You should kick one person on the ground because if the whole company fails, 300 people are unemployed. That means everyone fucks up. And this is exactly what we're proving more stability. On the other hand, the second layer of this analysis is why it's good to help undervalued companies, because you're exactly providing a merit and justice, let's say it in this way, economic justice, to people who actually deserve to succeed on the market. This means more financial transactions that are stable. Number two, it means a bit more like social justice, that companies that open the market and are undervalued because of racial biases or sexism, like women who are in companies are undervalued if they're CEO of these firms, are more likely to be on our side uplifted, right? So this is argument number one. Our second extension is about the way how social narratives are changing. So think about it this way. When Warren Buffett became a superstar in media, what he was saying in like 90s and 2000s, etc., was that everyone should invest. He was encouraging everyone to buy stocks, invest, and do stuff. Guess what happened? A lot of people who were uneducated started investing and losing money. These are like billions of dollars and billions, which people started losing. Why is it better on our side? Because once we have this technology and we're not banning it, it means that people are less likely to trust these systems, and a lot of millionaires are literally telling you to stop investing and find better ways to do it. I'm going to give you an example from my country. Karel Janeček, everyone in the back room knows who it is a person who is a multi-billionaire in Czech Republic who has these companies. What he says is,
stop believing the markets, stop investing there, don't lose your wealth or don't gamble your wealth in it, invest in these funds. This is, by the way, what opening opposition was saying. So people are more likely, yeah, I support you. So this is exactly what we're trying to prove in this case. You're more likely for people who are uneducated and unable to predict these markets to simply put it in the most stable way instead of investing in eToro or all of these shitty products that are not providing them any kind of benefit, right? So on our side, we're number one, providing more stability. Number two, we're providing more help for poor people or generally people who are uneducated in these ways and used to before we had these technologies to believe them. No. Now, moving to reactions and why we think all of the cases, etc., are just wrong. Number one, opening up government. I think the whole characterization in first speech was completely wrong, as I pointed in my POI. Yet, like, you're missing out on correlation. Like, it's the reason why they are so speedy is because they have better pattern recognition. They're more able to understand this data. The data was provided in Anička's speech. I think this is just clearly the way it works. And this is exactly why we have more stability, because you have more information. Like, the more access to information you have, the more likely you are to do this. Number two is when we look at, give me a second, no easier program. Why do I have so many exclamation marks? No. Yeah, let's move quickly to the monopoly idea. Like, I know in debate circuit it's easy to bullshit on monopolies and say like, monopolies bad, let's break them. But it doesn't really work this way. Because just because you have more dependency on the companies doesn't mean that these companies will not fail. Like, on our side, yes, you have a little bit less diversity, but because you have more information, more stable markets, they're less likely to fail. It doesn't matter if you have 8 companies and one of them fails and everyone loses their wealth and like, you're fucked up. On our world, yes, you have a bit less diversity, but these companies are less likely to lose, and Pagapsu, it doesn't really prove anything on your side. When we look at closing government, I think I already explained the economic mechanism behind that, but I also think there is one more point to address there, the panic on the market. If you think about it, this was Anička's one of the analyses that she presented there. The only way a market can panic is if it believes that people are doing wrong investment and things are overvalued or undervalued. But mostly it happens when it's overvalued. In our world, people have more belief in this market because they know that AI knows its shit. So you're less likely to have extreme volatility because exactly people know that they can trust the system. This is maybe one of the reasons why they were unable to identify a single fucking economic crisis since 2008, when in like early 2010s, we started using this technology. Ladies and gentlemen, oppose.
First to closing opposition, then to Anička's extension, and then to the comparison of the rest of the debate. So what we hear from the closing opposition is that because of this presumed mechanism of overvaluation and undervaluation, this is going to bring stable markets. Several points here. Number one, note that the biggest point and the only thing that this is contingent on is that the information that those algorithms and bots are using are accurate. At the point, we are going to show to you that these are not accurate. These mechanisms, everything from CO is falling down. So why are these not going to be accurate is, number one, know that this data is not going to be real. Because it's going to be affected by all those algorithms working together on those stocks, trying to make this changing, meaning they are not really going to focus whether the company is over or undervaluated. They are just going to see other bots trading and trying to focus on other bots trading. Number two, know that these are mathematical patterns and predictions. No, this is not somebody looking at the annual report of the company and trying to assess, like, was the investment correct, was it not correct, what are the reserves of the company, how many employees do we have, what is the long-term strategy of different things that we have with the people actually looking and doing the trade. This is just like looking at predictions which are by default not accurate information. Second mechanism, note that this fails even if this was accurate information because these algorithms are likely to overreact because there is so many of them and because they are trading so fast. That is to say that even if there was overvalued the company and the market would try to put their value down, because everybody is going to try to do at the exactly same second, it will overreact and crash the company too low, meaning it will be inaccurate representation of the value, meaning that there is going to be an unfair loss in the market, which we believe is bad. Second argument we have for closing opposition is that there is going to be a general push in the society to invest into funds and not like individual day trading. We think this is not going to be accurate and it's going to be made worse for the individual investors. Why is that? Number one, note that this change, this high frequency trading is not something that is like so popular and so widely known and so informed about among investors. We are saying that like there is still a lot of investors who don't really know about high frequency trading, and what they know and what they focus about are all those commercials that are pushing to them. This investment market, the market is something that is allow you to make a lot of money really fast and it's going to be very profitable. Meaning there are still a lot of incentive for these people to go and try day trading and try to make a lot of risky investments and make a lot of money. However, why is this bad? Is that like people are going to lose the money because all those high frequency traders are going to do what they are trying to do faster, meaning that they are inherently going to be unsuccessful and inherently going to lose money because they are still going to be pushed to make this investment. And second, we are saying that like once this is starting to like catch up the high frequency trading, there will probably be commercials and companies trying to like focus on the individuals and trying to sell them exactly those algorithms and products and say to them like, look, buy my algorithm, it is the best, it will be like good high frequency trading tool. Just spend a lot of money and it will make you money. Problem here is, again, you are still going to be losing to the big companies because they are close to the trading center and they can make it like in 3 milliseconds, while we will make it in 100 milliseconds, meaning that you will always lose. Meaning that the small investor is always screwed. Note that you will have chances to respond. What Anička brings to the debate and why we are beginning with this extension is, first of all, explaining from what opening government says about the information in the high frequency. It is that Anička explained to you the unique mechanism why high frequency trading brings volatility to the market. We think this is the most important mechanism coming from the government side. And that is because of the chain reaction of those bots and of those models that are going to bring instability, because in seconds the prices are going to go up, down, up, down, up, down again, meaning this, which sounds fun when we are talking about it right now, but it's bringing a lot of real life impact to the companies and to the markets, and I will like to present some of those impacts that Anička talked about. Number one, that the companies are going to lose value, and now what is important here to note is that unlike what Tim was saying, this is going to be arbitrary. Because we are saying that there's a lot of things that can trigger this chain reaction. There can be like one bad press conference when Elon Musk says something about something that is going to bring stocks down, and then the bots will catch up and destroy the company. It can be like just one bot doing something stupid, or one investor like selling something, and then the bots will catch up and skyrocket the company high. Why is this? Because we are saying that this is going to equally punish like good and bad companies, overvalued and undervalued, and it's going to be negative. And second impact here is that like the real life impact on those companies is that the companies are being forced to actually count on this and make up some kind of financial reserves for the volatility of the market, meaning that they can't invest all of the money they have into their employees, giving them good wages, or into the future green stuff and everything. In a second, not there. And second thing Anička brings as an impact is the potentiality of the crash, which is the biggest impact in this debate. If this happens, everything else doesn't matter. So even if there is a low likelihood of this happening, just the impact itself is the biggest. I will take the opening now.
When humans see red arrow go down, they sell because they panic. Machines, however, they just see risk assessment goes up. That means low risk funds sell, high risk funds buy. The market balances out.
We are saying that note, what Anička uniquely explained to you is what these algorithms, what information that are using. They are using information based on mathematical predictions, and they are using it in seconds, meaning that whatever the reaction is volatile, which is by itself a negative impact on our side. Second impact we have from our side is that impact on investors doing it on different scales. Now to the opening tables, so we mentioned them as well. So from here, from the opening opposition is first that these models are going to make fewer mistakes. Note that they made a mistake here of thinking that being faster means having more information. Anička uniquely disproves to you that this is absolutely nothing. This has absolutely nothing to do with these kind of mechanisms. That's not how they work. They work on mathematical models. Second, about the small investors, we see that we have proven to you that are going to be those big companies that will have the money to buy these kind of programs and invest into the high frequency trading, meaning that the small investor is going to be fucked up, which are the unique impacts again coming from Anička's side of the table. Last thing about the big social payout and potential profit. Note that when we prove the volatility of the market, it means that the risk is still going to be there and the risk is still going to be big, meaning that the social funds are not going to invest into this because it is a risky product inherently, or are going to invest and potentially lose money, which is going to be really awful for those companies. For all those reasons, please call closing.
Okay, guys. unlike Anička during COVID, I was renovating a motorbike, right? So pretty much how this system works, I've got from Anička right now. We definitely do agree with that type of system. We think it's great. All right. I'm kind of an arts guy, I don't know that much about finance, and I actually believe that in this specific motion, it gives me a competitive edge over other teams that went super hard on like explaining how the system works, but the debate is pretty much decided on the undecided voter, the average informed voter, and not basically like the most expertise-driven voter. So I will try to summarize the debate from this perspective, which I do believe is most valid within the guidelines of the debate. So let's compare essentially what the teams did. We have a huge clash basically on opening, talking about risks. Risk this, risk that, right? The opening government is trying to explain to you why risks will be mitigated in the world. Number one reason was that, or the first reason was given was that people are slow, so they are like far more likely to make less mistakes because they do like less things, which is like fair enough and kind of makes sense. But in the end of the day, the algorithm also, if it seems that it's making a mistake, will be far faster to react and correct its course and then basically switch up. So I think that that kind of is disproven by that, like just people being slow to the depth of the analysis that they have brought, not really being true. Second, this idea about a psychopath making an AI and that's going to destroy the world, that's like some DC level shit where basically like some underfunded like governmental organization is going to ruin everything. I don't know like what is your perspective about traders. I don't see them as the most humanitarian people to begin with. I'm not going to call them all psychopaths, but they're more on that side of the spectrum, let's say. So I don't really think that just like creating this one algorithm by a psychopath is as strong of an argument, because it's like already in the world as it is, essentially the people aspect is not such a huge safeguard that's going to protect us all, given the likelihood of the people that are there. Lastly, they have talked about monopolies and how monopolies are bad. The extent that I understood it, and Tim asked even in the POI, why is it always bad? And guys, judges, challenge your bias that's left leaning against monopolies, right? The only explanation I've understood was that if I have 3 companies and one of them fails, I will lose a lot of money. If I have 8, one of them fails, I still have 7 to save my pension. Again, I don't know if this is like my lack of knowledge of investments, but if I invest in a company, that company fails, the money doesn't like reappear somewhere else. It's gone. Just because like I have more companies and one of them goes bankrupt, I don't somehow like make money somewhere else. My pension is gone, that's that. What Tim was explaining to you, and it was our unique impact, was why these companies are far more likely to be stable. The high-frequency trading companies are far more likely to be stable, and their stability makes more than up for the lack of diversity that we have on the market. Because we will have less monopolies on the market, but those monopolies will be safer, more safeguarded, more stable, right? That's basically like opening government. Now, closing government brings, I think the main point that they brought, that was like the strongest, was this like bot fuck up, right? The bots immediately, like one bot sells, another bot sells, it cascades, now all of a sudden the company goes bankrupt. Again, I don't think that that's necessarily how it works, especially for the reason because at the time of in a market, when a company is trading, all the bots are not in the same position. All of them didn't just buy, or all of them didn't just sell. Most of them are somewhere in between, where they are either ready to buy or they're ready to sell. So if some bots start selling, the bots that are ready to buy see that the price is falling down, therefore are incentivized to buy that share, because now the share is trading at a better price, therefore balancing the thing out. That's what Tim was telling you. And this is a micro adjustment level that only bots can do. Only an algorithm can do. People cannot work this fast, and people also believe stupid bullshit, which was Tim explaining to you, where there can be, for example, some kind of like racial or bias or prejudice or bigoted opinion that they have, for which they will not to trade, which is not something that algorithms do. Algorithms go for profit. If the profit is there, if the money is green, they will invest in any company, no matter the bias, the creed, whatever. I will take closing.
Okay, your book was a case about like undervalued, overvalued companies, and contingent on the fact that there is some real information at the market, which is now not the case because the majority of the information input into the market is arbitrarily done by bots, not by somebody like checking the company.
Perfect. But like even as I said, I've understood how this works from you, and you say in your speech that it's not like taking whole Google and analyzing all of the data. It's just checking the micro assessments that other bots are doing, how basically the curve is moving up or down, and that's how it's making the decisions. So that's the information it's working with, and this basically like trend is more likely to be stable in our world because the bots are going to communicate lightning speed wise, and they're going to be extremely fast and adjust these things super quickly. Now, last point to this, to the bots fucking up, right? Do you know when this was the most likely event that this happened? The most similar thing that happened to this bot fuck up. It was the time when people started buying NFTs and crypto